Welcome to Global Monetary Watch, delivering research-based insights on global currency policies.
If I told you that the price of a single barrel of oil can decide the fate of an entire nation's currency, the strength of a country's money in your pocket is directly tied to pipelines running thousands of miles across deserts and oceans. Oil is not just fuel. It is power. It is influence. For many countries, it is the backbone of their currency stability. Today, we are diving deep into oil revenue trends and how they shape the strength or weakness of national currencies across the world. Oil has been the engine of the global economy for over a century. But for oil exporting countries, it is more than just a commodity. It is government income. It is foreign exchange. It is budget security. When oil prices rise, billions of dollars flow in exporting nations. Governments collect more revenue. Foreign reserves increase. Confidence grows. And often, their currency becomes stronger. But when oil prices crash, the opposite happens. We have seen this cycle many times in history. In 2008, oil prices surged to record highs. Exporting nations experienced budget surpluses. Their currency strengthened. Investment increased. But then, the global financial crisis hit. Oil prices collapsed. Suddenly, government revenues shrank. Pressures mounted. Economic uncertainty spread. This pattern repeated again in 2014 when oil prices dropped sharply due to oversupply and slowing global demand. Countries heavily dependent on oil exports faced immediate fiscal stress. Their currencies depreciated. Inflation increased. Governments had to cut spending or borrow money. Why does this happen? Oil revenues are usually earned in US dollars. When a country exports oil, it receives foreign currency inflows. These inflows increase demand for the local currency. Governments can use these dollars to stabilize their exchange rates. But if oil income falls, dollar inflows shrink, currency demand weakens, and depreciation begins. This relationship creates what economists call commodity currency dependency. Some countries manage this risk well. Others struggle. Let's talk about diversification. Countries that invest oil revenues wisely, building sovereign wealth funds, strengthening non-oil sectors, and maintaining fiscal discipline are better protected from oil price volatility. They save during high price years and spend carefully during downturns. This creates currency stability even when oil markets fluctuate. Countries that rely too heavily on oil without diversification face serious challenges. When oil revenue drops, they experience budget deficits. They may print more money. Inflation rises, confidence falls, and the currency weakens rapidly. Another major factor is foreign exchange reserves. Oil exporting nations often build large FX reserves during boom years. These reserves act as a shield. When oil prices fall, central banks can use reserves to defend their currency in global markets. Without strong reserves, currencies become vulnerable to speculation and capital flight. Now let's look at the long-term trend. The global energy transition is changing everything. Renewable energy is growing. Electric vehicles are expanding. Climate policies are tightening. While oil demand is still significant today, long-term projections suggest slower growth compared to previous decades. This creates structural uncertainty for oil-dependent economies. If future oil revenues decline permanently, countries that fail to diversify could face long-term currency instability. Their financial systems may struggle, their fiscal budgets may shrink, and their exchange rates could become more volatile. Geopolitics also plays a huge role. Sanctions, wars, production cuts, trade disruptions can cause sudden oil price spikes or collapses. These shocks immediately affect currency markets. Investors react quickly. Capital flows shift. Exchange rates move within hours. It is not just an economic commodity. It is deeply political. Another important concept is the exchange rate regime. Some oil exporters peg their currency to the US dollar. This provides stability and reduces volatility, but maintaining a currency peg requires massive reserves and strong fiscal management. If oil revenues decline for an extended period, defending a peg becomes costly. Other countries allow their currency to float. This means the exchange rate adjusts naturally when oil prices change. While this may lead to short-term volatility, absorb economic shocks more flexibly. There is no one-size-fits-all solution. The key lesson is this: oil revenue alone does not guarantee currency stability. Matters is how that revenue is managed. Disciplined fiscal policy, strong institutions, diversification strategies, sovereign wealth funds, controlled inflation, transparent governance, the real pillars of long-term currency strength. History shows that oil windfalls can create prosperity, but they can also create dependency. Countries that treat oil revenue as temporary income tend to survive long-term cycles better than those that treat it as permanent wealth. Looking forward, global oil markets remain volatile. Fluctuations, supply decisions, geopolitical tensions, and the energy transition will continue shaping revenue flows. For oil exporting nations, the challenge is clear: Build resilience before the next downturn arrives. Because oil prices will rise again, and they will fall again. Currency stability depends not on the price of oil today. It depends on preparation for tomorrow. In the end, oil is powerful. But financial discipline is even more powerful, is the real story behind oil revenue trends and currency stability.